First, we have Popular Incorporated, the parent company of Banco Popular, which has been making waves in the banking industry. However, we won't be discussing that story today. Instead, we'll be focusing on Procter & Gamble and its recent earnings report. Procter & Gamble, the consumer goods giant, has reported a mixed bag of results for its fiscal fourth quarter. While net sales rose 2% year-over-year to $21.2 billion, organic sales were flat, with all growth coming from pricing rather than volume or mix. Core earnings per share declined 3% year-over-year to $1.43. The company's guidance for fiscal 2027 was also cautious, with management expecting organic sales growth of 1% to 3% and core earnings per share of $6.89 to $7.11. The midpoint of that range implies growth of less than 2%, which is a concern for investors looking for more robust returns. One of the main headwinds facing Procter & Gamble is higher raw material, energy, and transportation costs, which are expected to total around $1 billion in after-tax expenses. Additionally, net interest expense, lower non-operating income, and unfavorable currency fluctuations will also contribute to a 0.56 per share drag on earnings. While the company's dividend payout looks safe and the business is durable, the current valuation of around 21 times fiscal 2026 core earnings may not be attractive enough for investors seeking faster growth. To change this outlook, we would need to see evidence of volume growth or a more favorable price point, potentially around $130 per share, which would yield close to 3.4% at the current payout. In contrast, we also looked at another story about Popular Incorporated, but that will have to wait for another time. For now, let's focus on the key takeaways from Procter & Gamble's report and what it means for investors. We'll be discussing this topic in more depth later in the show, but for now, let's take a break. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the latest developments in the world of finance and economics. In a rare joint action, both countries intervened in the foreign exchange market to halt the slide of the Japanese currency, which had weakened to a fresh 40-year low. This coordinated effort is the first of its kind since 2011, when the two nations took action to weaken the yen after a devastating earthquake and tsunami hit eastern Japan. The move aims to prevent a sell-off in the yen and Japanese government bonds from impacting the global economy, including potentially pushing up borrowing costs for Washington. The U.S. Treasury Secretary and Japan's Ministry of Finance have confirmed that they will not hesitate to conduct more joint interventions in the future if necessary. This decision highlights the efforts of both countries to maintain stability in the financial markets and prevent excessive volatility. It's worth noting that the yen's weakness is largely due to Japan's lower central bank interest rates compared to other major economies, such as the U.S. The Bank of Japan raised its main rate to 1% in June, while the U.S. Federal Reserve's benchmark rate is in a range of 3.50% to 3.75%. Japan also faces challenges like a declining working age population, low productivity, and reliance on energy imports priced in U.S. dollars. The joint intervention has had an immediate impact, with the dollar falling against the yen after the announcement. However, it's essential to consider the potential long-term effects of this move and how it may influence global economic trends. As we continue to monitor this situation, it's crucial to remember that currency markets can be highly unpredictable, and the consequences of such interventions can be far-reaching. We'll keep a close eye on developments and provide updates as more information becomes available. Welcome back to the Riskwiser Zone. Today, we've been exploring the world of hedge funds and the impact they can have on the market. Now, let's dive into a fascinating story that highlights the risks and rewards of investing in the AI space. You may have heard about the Situational Awareness Hedge Fund, which recently made headlines due to its forced selling of AI-related stocks. The fund's over-leveraged position led to a significant sell-off, causing market volatility and raising concerns among investors. However, some experts argue that this volatility is not a reflection of the fundamental strength of the AI sector. In fact, companies like Micron Technology, a leading player in the memory chip industry, are still experiencing robust demand and supply constraints. This has led some analysts to increase their exposure to AI-related tech, infrastructure, and select enterprise software names at discounted valuations. So what can we learn from this story? Firstly, it's essential to remember that market volatility can be triggered by various factors, including forced selling by over-leveraged funds. Secondly, it's crucial to separate the signal from the noise and focus on the underlying fundamentals of a sector or company. While the situational awareness hedge fund's woes may have caused short-term pain for some investors, it also presents an opportunity for others to buy into the AI space at discounted prices. As always, it's essential to approach investing with caution and carefully consider your risk tolerance and investment goals. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.